Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Friday everybody. Weekend is almost upon us. We have a couple of major developments we need to cover, so let's just dive in. And let's start by looking at the lockdown and outbreak situation. Small, stubborn and sporadic outbreaks continue to test anxious officials across the country and plunge wary residents into lockdowns or restrictions. Some local governments, under the tremendous financial strain of mass testing regimes, and already facing historically trying fiscal conditions, are beginning to roll back testing too. After more than a month of no cases, the southern megacity of Shenzhen has reported sporadic local COVID-19 cases in recent days. Some parts of the city have been locked down, and all residents are now required to show negative nucleic acid testing results obtained within 48 hours when using public transportation or entering public areas starting from Friday. Today. Not too far from Shenzhen, on the other side of the Pearl River Delta, the Macau Special Administrative Region on yesterday, reported 39 new COVID infections, bringing the total number of official infections since Sunday to 110. Yesterday, indoor entertainment venues, including cinemas and theaters, were closed, and only takeaways are allowed at restaurants. Casinos remain open, though, for now. As we have seen in previous videos, Macau's critically important casino industry has been smashed since the start of the pandemic, with local authorities even warning of social instability due to job losses. Yesterday, Macau's chief executive said at a briefing that they will only close individual casinos if they find a case in gaming spaces. Cities across the country are also beginning to reduce or halt large-scale mass testing of residents, despite not that long ago the highest levels of leadership calling on mass testing rollout across the country. This rollout, as well as the costs, are both areas or themes that we have been following for some time now on China Update. State media is framing the shift in policy as a result of improving conditions. Quote, "In light of the stable overall improvement of the epidemic situation in many areas, multiple cities have adjusted their request for the nucleic acid testing cycles. Some cities extended the regular testing period from 3 days to 5 days, while others cancelled the regular testing request." End quote. Some analysts, including yours truly, are somewhat skeptical of this explanation, arguing instead that the primary reason for the policy relaxation is the incredibly high cost of mass testing, a cost that some poor regions especially simply cannot afford. Indeed, as we have seen in previous videos, in some cities the cost of mass testing residents is more than the entire annual health budget of these localities. Hey guys, if you like what I'm trying to do with these videos and you want to help support the channel and keep it sustainable, Patreon, buy me a coffee, which is a great way to give a one-off tip, or crypto links are in the description below. If you're enjoying the video, don't forget to the like button, and sharing is a huge help as well. Thank you so much everybody for the ongoing support. Next up, with signaling from the State Council that the worst of the years-long devastation of Beijing's crackdown on Chinese technology companies may be over this week, and now JP Morgan doubling down on China tech stocks, retail and institutional investors alike are considering wading back into the dark waters of China's capital markets or snapping up Chinese ADRs. The question is fear turning to greed once again? Rebecca Jiang of JP Morgan Asset Management, managing total assets near $20 billion, expressed this week that her firm has not reduced holdings of Chinese tech stocks in recent months, arguing that the sector provides critical value to customers, regulatory hurdles are being cleared, and China's macro policies are offering support. She told a Hong Kong interviewer this week in a very matter-of-fact way, quote, "The worst is over." End quote. Indeed, her China fund has increased holdings in Alibaba Group Holdings Limited and JD.com Inc. this year. We remember that China equities markets have had a very hard last 12 months, and technology stocks in particular felt the most pain. Technology stocks saw near $2 trillion in value wiped out at its worst point. Rebecca Jiang's China fund lost 20% last year. However, she and others are betting now that monetary and fiscal support and a more stable regulatory environment will mean Chinese stocks outperform global peers for the rest of the year. We will see. Next up, next week, the North Atlantic Treaty Organization, NATO, will be holding a summit in Madrid, Spain, and the implications of the inclusion of New Zealand, South Korea, Australia, and especially Japan is not lost on Beijing. Nor is NATO's new focus on China a secret. This week, NATO Secretary General said that Beijing will be a key theme for this leaders' summit meeting, expressing, quote, "I expect that allies will state that China poses some challenges to our values, to our interests, or to our security. And this, of course, has an impact also on how NATO should react in a more competitive world. I think we have to understand that for NATO, this is a big step, because in the current strategic concept, China is not mentioned with a single word." End quote. A reinvigorated NATO looking east with the backdrop of the Ukraine war is likely a great source of anxiety and vexation for a Beijing coming down off the high of several years of triumphalism. State media and the foreign ministry establishment is not keeping their disconcertment to themselves either, preparing their narrative for when the summit kicks off next week. Quote, "Such a move is dangerous and will trigger high vigilance and firm opposition from Asia-Pacific countries and the international community. China has always been a builder of world peace, contributor to global development, and defender of the international order. We urge NATO to stop provoking confrontation by ideology, stop spreading disinformation and provocative remarks against China, and stop trying to start a new Cold War. NATO has already messed up Europe, and as such should stop messing up the Asia-Pacific and the world." End quote. This sort of framing from Beijing is unsurprising, and state media has taken a similar line. While most of this coverage and this framing is for a domestic audience, state media may be correct, however, in their argument that Europe will be more hesitant and perhaps even wary than the United States in expanding the scope of NATO to include China in any meaningful way. And New Zealand and South Korea are also softer underbellies compared to Australia and Japan. We will be following the NATO event closely next week. And finally, the Chinese housing crisis. In an exchange filing on Thursday, and after Moody's cut its rating to junk, China's largest property developer by sales, Country Garden Holdings Co. Limited, announced that it has brought back the majority of an offshore bond that was due next month. Country Garden has remained one of the more healthy property developers in China and one of the few private firms that has still maintained financial institution support to issue new onshore bonds. Despite this record, however, on Wednesday, Moody's Investors Services Inc. lowered Country Garden's issuer rating from the investment grade of Baa3 to Ba1, the first stage of what is considered junk bonds, or speculative grade, as some in the industry describe it. A speculative grade carries higher risk than investment grade bonds, in theory. Country Garden's ratings outlook was also lowered to negative. Quote, "The rating downgrade reflects Country Garden's declining property sales and deteriorating financial metrics amidst the challenging operating conditions of the China property sector, as well as its weakening access to long-term funding. The negative outlook reflects Country Garden's reducing liquidity buffer and financial flexibility, driven by falling property sales and continued weak market sentiment in the next 6 to 12 months." End quote. Country Garden's problems are not unique to it, of course. As we are painfully aware, China's entire housing market is in crisis, and most developers are suffering a double sales and financing hit. Chinese real estate developers are struggling to meet sales goals as home buyers stay away amid pandemic controls and a weak economic outlook, despite government efforts to bolster the property market. We remember that housing sales have been dropping at a double-digit pace every month since August 2021, with the decline widening from 39.7% in January to 59.4% in May, according to market research firm China Real Estate Information Corp. Total sales of developers from January to May declined over 50% year on year, a reduction of almost 2 trillion RMB. Country Garden's performance was slightly less bad than the industry as a whole, with contract sales falling around 40% year-on-year for the first 5 months of 2022. And with investor confidence in the housing market, both at home and abroad, at all-time lows, developers are facing a financing side crisis too. According to new data from property consultancy China Index Academy, in the first 5 months of this year, Chinese developers issued 14.3 billion yuan, $2.13 billion in new offshore bonds, equivalent to only 9% from the same period last year, an incredible 91% collapse. Country Garden does not have any other US dollar bonds maturing this year, and expressed to investors yesterday that despite the downgrade from Moody's, it still has confidence that it can weather the current storm. Moody's, however, argues that China's largest developer's continued access to long-term funding, something that's critical to its survival, remains an open question. Okay, that is today's episode. Thank you so much, everybody. I'll see you tomorrow.